much for having us today.
Thanks, Max. Great to be with you.
We're talking at a time when there's a lot of reshuffling happening in the real estate market in terms of a lot of the big firms, or the middle-sized firms, I should say. What do you make of all of this?
I think it's interesting looking at the mid-sized firms, as you mentioned. I think we've seen that it's been tough or difficult for them to compete in the New York marketplace, more so for the firms that really only operate in one vertical. So if you're just doing retail leasing, I think it's challenging to support your clients that might need help on the industrial side of the business or in some type of debt practice. So I think it's been a little bit harder for those businesses to compete. What we're looking for right at the moment is to bolster our debt and equity platform. We certainly have a strong backbone from our acquisition of Harrison Street, so our investment management team is extremely strong, but from a local level, from some of the movement that we're seeing here in New York, I think we're vetting out some of the brokers that are potentially exiting the mid-level shops that are oscillating right now, but also other firms. You see a lot of brokers when things kind of come to a standstill, that's when you see a lot more movement. So I think we're seeing more movement, not just in the mid-level firms, but I think across the city. So I think we're looking to bolster that practice.
What are some of the challenges in the market right now for New York specifically?
I think on the investment sales side, we've certainly seen capital appreciation level off. I believe Manhattan remains certainly a strong hedge against any near-term economic uncertainty, but we're off about 33% from a volume perspective on the investment sales side, and we've had a couple of one-off transactions like Chelsea Market, like St. John's Terminal, that kind of pumped numbers for us a little bit in the first half of the year. It's be interesting to see how we end the year 2018. I think what's interesting right now is that pricing in Midtown South in Class A, B, and C has all surpassed that of Midtown, and it's surpassed the Manhattan average. It's the first time that's happened in history.
Why do you think that Midtown South is doing so well right now?
I think it's the kind of the continuation as we've seen so many blocks pulled down. There's not a lot of large blocks of space. You kind of have this extreme demand from the Facebooks of the world that are taking large blocks of space. You have a competition every time there's even 10,000 square feet of space in Midtown South. You'll see 4 or 5 proposals coming in, 4 or 5 offers from bona fide tenants. So it's an attractive market. I think you're still seeing executives that want to live where they work, where they play, and I think in most cases almost avoid Midtown.
You mentioned Facebook. Is that the profile of a lot of the tenants? Are we seeing a lot of TAMI tenants?
I do believe it's a lot of TAMI tenants. Look, I think this started right when Google took over 111 8th Avenue, and a lot of people wanted to move into that submarket. Google almost became its own submarket amongst itself, and you had a lot of tenants that wanted to be close to that. That kind of moved its way a little bit further east and kind of took over more of the Midtown South Flatiron market. But now it's not just the TAMI tenants. I mean, we certainly work with hedge funds, financial services firms that want to be in Midtown South. We've seen some law firms as of late that are looking in Midtown South, real estate services firms that are moving to Midtown South. So I don't believe it to just be that small group that followed Google originally. I think now it's a wider variety of tenants that are looking in that market.
David, you've been at Colliers as president now for 3 months. Tell us about how you came to the role and what you've seen so far.
Certainly an interesting transition over to Colliers. I've been a huge fan and very friendly with our president, Dylan Taylor, for about 7 years now. Met him at a conference at one point, and we came to know each other and spent time together pretty much every quarter for the past several years. I really enjoyed getting to know him and Jay Hennick, our CEO. So it didn't take much for them to convince me to come over. As you know, I spent time at Cushman & Wakefield and after that at SL Green. So I had a really strong understanding of not just the New York City market, but also from the brokerage perspective, doing global work at Cushman & Wakefield. So felt fortunate that Dylan Taylor and Jay Hennick tapped me for this role. And I still get my feet on the ground. A lot of real estate, obviously, for us to cover. But I feel very fortunate to be working with such a strong leadership team.
And where do you want to take Colliers?
So I think If you look at Colliers as a whole, we're the fastest growing publicly traded real estate services and investment management firm. So 12,000 employees, 400 plus offices, 69 countries that we're operating in right now. So I obviously look to parlay our expertise across the world into the East Coast markets. I think right now there's certain areas where we can improve, like any other organization. And I think as we talked about with some of the other changes in this market here, whether it's New York or Boston or DC or LA, there's new talent to pick up. We just hired a great new Senior Vice President of Innovation and Technology, who is working with our brokers to try to help develop new technology that's going to help us service our clients. So I think we're bringing on new expertise in-house to help us figure out the best way to move the business forward.
Well, David, thank you so much for having us today. It's a pleasure.
Thank you, Max. I appreciate it.